Good afternoon, everyone. This is Chris. It's welcome. It's October the 2nd. Hard to believe October is here already. Welcome to our monthly Connect series for premium members. So let's go ahead and get started. But before we do, I just kind of want to take a moment of silence. That most of us woke up to some pretty tough news today and from Las Vegas. And so if we can just kind of have some thoughts for the people that have lost loved ones and those that are injured and trying to get better, and those that went through an experience that they didn't deserve. So let's just take a few moments and pause and be thankful for what we have. Amen. As a reminder, each month that we start off with at Kimble Charting Solutions, we're not a bull or a bear. We believe that being bullish or bearish is nothing more than a psychological state of mind, and we attempt to try to find strategies and patterns that can be efficient and helpful to all of us making decisions. And again, a reminder that we hope that the power of the pattern can be your 28-second solution to investment research. We know you have many choices around the world, and we're grateful for the members that we have that have been here year after year after year after year, and our new members and people that are giving us a shot from a trial perspective. And so we feel really blessed and honored, by all of you, and Rick and I are really grateful, and we send our thanks. And we're continuing to try to do our best that we can at this end, and we appreciate again your membership and any feedback that you have on how we can be a better experience as a member. Let's get started on some the stock indices, and I could almost just take this one chart and pretty much summarize how the market's doing, probably how you ought to be positioned, and if you're fighting against this, it's probably a frustrating time. This is the NYSE index, the Advanced Decline Index of common stock only. Closed-end funds and bond funds have been stripped from this indice, and the main point is the trend is up and it's at new all-time highs in the upper right of the chart, as is the market is at all-time highs. So this is a pretty healthy looking chart. As you know, we continue to share this every week in the global dashboard. We would get a concerning message, which we're not getting, if this would start to deteriorate, or most commonly we see an advanced decline line divergence or a negative divergence, that it heads south when the market is heading up. That's when you kind of get some concerning messages from this, and we're not. And so despite, as we'll discuss a little bit ago, that 30 days ago, there was a lot of, we shared the charts on the typical September performance. A lot of people on the web and social media did as well. It wasn't a revolutionary statistic from us to you guys, but the bottom line is price is king with us, and when the prices are moving up, despite a statistical suggestion that September was to be soft, you all know that we didn't go into that mode or become bearish or concerned. We kept our long positions, and the only thing that we did was pull up some stops. So here's a chart that's a little bit further expanded. Thanks from help from a good friend, Ryan Dietrich, with this. On the left side, you see your months, your left column. The next column is ranked by typical performance. This is based upon the last 20 years, from 1997 to 2016. Before we go any further, you can see where September is number 11. So August and September, or the last 20 years, were the two lower performing months. And you can see then we're entering into the month of October. So over the last 20 years, October has been the second strongest month, only followed by April. And so the average gain for the month of October over the last 20 years is about 180 basis points, and it's higher about 2/3 of the time. You see in the fourth column over on percent higher. There are some other months, you can see November and December are typically, they have a higher statistical percentage of being higher, but then the performance is not quite as good as October and April. The thing that I find interesting about this chart is that the statistic that jumps out is that October, when the market is up going into October, that the average performance is a little bit over 500 basis points, or 5% in the month of October. And so, as we all know, the market is up going into October. There's no promises that the market's going to make 180 basis points or 500. But the thing that caught my attention of all of the months over the last 20 years, when the market is up, October has the statistical largest percentage gain of any month there is. And so we all know that we, despite the really tough news out of Vegas, this is a look at the very first day of the month and the S&P 500 sector performance, as you can see at the top. I don't know about all of you, but it gets deceiving. The numbers are so big when we see the Dow up 100 and some points or whatever. It just seemed huge. Humbly, I gotta say, when I got into the business in the early 80s and the Dow was under 1,000, if we had a 40 or 50 point gain, which we did in 1982, excuse me, those were huge percentage gains. And so this old guy, sometimes it's hard to believe that, when you see a really big gain in the Dow, the percentage wise, it's not that large. But to start off the month today, the S&P was up, and you can see at the very top about 40 basis points. And it's always nice to be blessed and lucky. And so we were lucky and blessed today. As far as 3 different positions that we own were the 3 best performing S&P 500 sectors. That materials led the pack, followed by healthcare and financials. So not a bad start when the month typically is up 186 basis points, and some of the holdings on the first day doesn't mean that we'll be able to keep them, but some of our holdings almost made half of the typical October month just on the very first day. I think this is kind of this is a look back on September through October performance-wise. A lot of lines here, everybody. I apologize, but the one thing that you'll notice they're all gravitating pretty much from the left, lower left, and moving up to the right. But as it was kind of interesting to me is that most of these really curled and started turning higher where I put that blue vertical shade, which was just essentially a little bit over a week ago. And I don't know if it had anything to do with the October seasonality, the awareness of the public that's typically a good month, but whatever has caused it, you can see most of them really started advancing. So over the last 30 days, one of the laggers of the whole year was the Russell. You see it was up 600 basis points, or 6%. In the middle of the screen, and the black box was the S&P that did 1.3. So it did something that it typically didn't do in September. Is it made money, made above statistical averages, and we were fortunate and blessed, as members, to have a lot of long positions that were up more than that 1%, during the month of September. So just kind of want to let you know that, boy, it really, this move that we'll see if it does follow through in October. September surprised the majority, and as I wrote last Friday, it'll be interesting if October's numbers are trick or treat, as far as most everybody now is going to become aware, oh, this is really a good month historically. We'll see if it pans out to be that way, but right now everything's acting in well, so it'll be a surprise to me if a month from now we're still not even pushing higher. But anyway, that blue vertical line just kind of shows how the majority of these indices really started to ramp up from essentially the 25th, 26th of September, going forward. Here's a look at how the typical October has shaped up as far as we know the month is typically, up, but with the help of, again, good friend Ryan Dietrich, Ryan put together what the average October looks like for the last 10 years and the last 20. And you can see that they're both up. The last 10 years hasn't been as strong as the last 20. The one thing that does kind of catch my attention, and we'll just see if it's meaningful or not, is that in both of these windows of time, the market was essentially strongest from around October the 9th going forward. So we'll see if, roughly a week from now, today's the 2nd, so on the 9th, next Monday, historically, that's when the bigger push of strength takes place in the month of October. We had asked some members if you had any questions to shoot us some, and John M., I know you know who you are, and all of the people will with your questions. We appreciate the questions that we did receive. We'll do this more than once, and I do hope we can continue to get a good influx of questions, because I really like being able to share some of those things with you. But one of the questions was, Chris, do you look at the big picture? And I always do. You know, with being a student of Sir John Templeton, I can't get away from looking at the big picture and looking at valuations. But I just kind of want to share this chart from a big picture perspective. And this is the S&P 500 divided by the BKX, or the financial ETF, XLF. And it's almost a 20-year snapshot, but you can see for the most part, this thing's got a downward slant from the financial crisis, 2009, and now it's pretty much moved sideways. But you know, kind of when John had asked about the big picture, you know, to me the banks are just really important. They helped really cause a lot of issues in 2007 to 9 and the quote-unquote financial crisis. But one of the things I wanted to highlight is at number 1. This was when we suggested last summer to buy XLF, the broad-based financial ETF. There was a couple of reasons. It had been lagging and it was starting to turn up, and it was breaking above resistance at the lower one. And if you go to the top of the screen, you can see momentum was low and starting to create a small series of higher lows. And so XLF really took off, and we harvested a good part of that position. And you know, one of the questions is kind of how do you determine, Chris, where you might harvest some of the things? And I want to kind of share behind the scenes is that we harvested a good part of this position right at the first of this year, when the market overall, with the new election of a new president, was pretty much rocking and rolling. But you'll see that banks outperformed and became really overvalued, or the momentum of banks at the upper 2 was higher than at any time in the last 17 years. That caught my attention. It was up against dual resistance, and that's where we backed off from those positions. We're going to go into some other bank holdings that we have, but you know, right now we own 3 different bank positions. And so one of the things that intrigues me, you know, right now is that the ratio is at 3, which is up against falling resistance right now. And if it would happen to break this line that has been seemingly influential, I would suspect a lot of people, when we backed away from some of the XLF holdings earlier this year, it probably seemed like a very questionable, you know, idea. But you can see, you know, the whole idea is to try to think of alpha and where can we outperform with the risk that we're taking. You know, the ideal situation is whatever capital that you have is that we can outperform the broad market. And so banks had outperformed the broad market. We pulled some back, and so now it's up against a really important resistance line at 3 that if this would break out, it'd be a positive, obviously, message that banks are starting to outperform again. So it could be a positive message for banks, and it could well be a positive message for the broad market as well. So a big test for this ratio is at hand, everyone, at 3. Momentum has backed off some to middle ground. It'd be kind of nice if it was oversold, but again, if it would break out at the lower 3, it'd be a real positive for the positions that we have. And obviously I have a bias being along a few different bank positions. This is the one, so now this is the bank index of BKX. Everybody just stripped completely. This is not a ratio, this is the pure index. We sold and lightened up on the majority of XLF positions at 1. And part of the reason was not only how momentum was so overbought, but it was kissing the underneath side of a long-term rising channel as it was spiking up at the first of this year. And so in the blue shaded area, that's pretty much just a horizontal rectangle box, there's a chance, everyone, that this is a upper level consolidation, creating a base to push higher off of. So right now at 2, the BKX is testing the prior highs at 1 and again the underneath side of this rising channel. And if we would get a breakout at 2, it would be positive for the banking industry, and obviously, you know, our holdings, and historically it would be positive for the broad market. So in my opinion, this is a really big test to see if the October situation is going to repeat as far as outstanding, you know, performance. So a big test, and if banks can break out at 2, it'd be a really positive sign. So if it does break out and you don't have some of the bank holdings, I would encourage you to really be thinking long and hard about that. So this is Want to kind of highlight, we've been sharing it for probably, I don't know, 8 weeks now, a couple of months, probably you're sick and tired of it. But the bottom line is when a market is moving up, one of the most positive patterns to accentuate the current trend that's in play is an ascending triangle. And I put, that pattern in the upper left, but I just kind of wanted to reiterate, we've owned Citi for a couple of months, bought it back in June, but you'll notice how earlier this year, when we lightened up on the XLF position, you can see even within Citi itself, it started chopping sideways and made no net progress for half a year. But what we were noticing is it appeared that a bullish ascending triangle was taking shape. Again, these take shape during, they are a continuation trend. They're not a reversal trend. Again, they're a continuation trend of a bull market. So if you're looking at some little minor potential of ascending triangle, but the asset, the indice, the commodity, or the stock is way below where it was a few months ago, folks, you don't have an ascending triangle because the trend isn't up. So I want to share here at 2 that it started to break out, and we bought to Citi, and you can see that it's pushed higher, and just kind of want to share again that it appears to me that in the green that Citi formed another bullish ascending triangle, another positive continuation, and you can see this is a weekly chart. So 3 weeks ago, Citi has pushed higher out of this pattern. So continuing progress in a very positive way in patterns that are historically in our favor. 2/3 of the time, these type of patterns lead to higher prices. And so this is the thing that we're wanting to see. It doesn't have to do with valuations, as long as we're seeing the advanced decline line that we started today's webinar off with acting strong. We're seeing the shoebox indicator acting okay. We're seeing other key ratios acting okay. That's where we want to really dig hard, and we're trying to do our research to save you time to find these ascending triangles so we can help find assets that can pop to the upside. One of the things that when we speak about alpha is when we saw whether it's XLF breaks above an ascending triangle or whatever. I just kind of want to share, we try our best, and it always doesn't work that way, but this is an example of from the day that Citi was purchased. We could have went and chosen XLF. We already owned a little bit of XLF, but the positive pattern in Citi to me overweighed buying XLF and many other bank stocks, and so we wanted to really look and try to provide everyone alpha for the position and the risk that's being taken, or your assets, your hard-earned money, that we could maybe really outproduce not only the indice, but the broad-based indice itself. So I just kind of wanted to show that since Citi was purchased, the S&P is the lowest one up here. It's up 400 basis points. So there's nothing wrong with what this roughly a 90-day period of time. Nothing wrong with the S&P making 4%. You can see XLF made 9%, but at the top, Citi happened to make almost 17% during that window. So that's almost a 50% greater return than the broad-based XLF itself. So I want to share when you see a suggestion of the power of the pattern says to buy Citi, we don't feel bad about XLF itself. So if you don't have access or you're not comfortable with buying individual stocks, don't shy away from still buying the underlying broad-based ETF itself. I'm just trying to take what I think is the best for the risk that we're going to take, that we can get the most amount of alpha out of these situations. And so to me, this is a personal success story that we hope to repeat, because this is what the type of thing that we're looking for, is that we can own a sector, but we can own something inside that sector that could really give us a lot more bang for our buck. And Citi has done that. You can see it even outproduced Bank of America and JP Morgan, which has obviously been a stellar bank stock, even happened to outpace JP Morgan. One of the questions from one of the members was, Chris, you've continued to show the small caps in the sectors report each week, and they look alike. Kind of a visual or idea that we've been sharing for a few months, and the kind of question was, why is it important to you? And what you like to see is the little guys, the troops, doing fairly well. And so just a little bit ago, on one of the prior charts, we showed that the bank index could be making it went sideways for several months, and there was a chance it was making an upper level base to break out of. And so this is why I've tried to share small and micro caps. The symbols would be IWM for the Russell, obviously the RUT for the Russell Index, or IWC for the micro. And you can see that both of them are breaking above and to the upside. So even though a lot of people have most likely avoided the rallies that have taken place due to valuations or whatever reasoning, that tools that they had to miss out on the rally, I want to keep updating things like this with you, which these obviously give me confidence when we seeing these type of positive things, and so we share them with all of the members to try to also share positive underlying strength that's taking place. And if the weakness was taking place, we'd be the first to share that too. But anyway, this is a good sign to see the little guys participating in a rally, and they've really lagged for the majority of the year, and then all of a sudden, just boom, in a 2 to 3 week period, they just came out like a rocket ship and did well. So impressive action. Thanks, Doug, for your question about small and micro caps. Todd B has asked me a few times to always continue to put this chart in here, and this was the one that we've discussed many times. It's in the reports for rather consistently, to where I made the comment there's probably a low probability of a repeat here, but a high impact if it would happen. And so to me, I just kind of want to share that back in 1998-99, this is the transportation index, and in 2007 there was a slightly higher high in the transportation index, which most likely looked to be a breakout. It would to most anybody, including myself. And all of a sudden, just reversals took place, and both fell apart. And so we've just been sharing that there was a potential of a repeating pattern. It wasn't about that just because that both of the prior ones that the transportations fell 50%. It wasn't about that a 50% decline was going to happen again. It was just the oddity that these patterns look similar. But we see continued strength in the transports in the upper right at 2. And so there is an early stage of transports reflecting strength and attempting to break this pattern that is bullish price action that's taking place at 2. Just a noisy set of indices, but I always want to remind everyone, if I don't put labels on here, the labels are in the charts in the top rows, the S&P, the Dow, and the NASDAQ, Russell, mid caps, value line, geometric, and then we go overseas to Germany, London, France, and London in the lower right. So it's just a really quick snapshot of the world, and you see that the trends are up. They're above quality moving averages, and there's not much concerning messages at this time taking place. So quality action. We're going to dig in, as we typically do, to Germany and France coming up. But I wanted to kind of go first to the emerging markets. The emerging markets since 2016 at the lows right here has been much stronger. This is EEM on a weekly basis. Emerging has been much stronger than the S&P, but we've tried to highlight that it's been good to be long here, but if you happen to be unfortunate and were a buyer of EEM in 2014, 13, 12, or 11, it's just been pretty much dead money. And if you calculate inflation into it, it's been a losing proposition. So the bottom line is that numerous times over several years, EEM ran out of gas at where it is right now. And so this is a very important price point, not only for EEM, humbly I feel for a lot of the whole world. This is kind of like the the mention of small and micro caps earlier. You like to see the little guy doing well if you have long positions, and I'd say this is the same thing. You like to see the little guy, the emerging market countries, doing well. So they did sell off last week, got thumped a little bit right up here at resistance. This is where bulls would not want to see selling pressure take place. You see a little bit of a wick where there was a reversal. So EEM was down last week overall, but it did come off of its lows and created a short-term bullish reversal. But the bottom line is, reversal or not, this is still, until proven differently, this is an 800-pound gorilla. But if I don't own EEM at the time. You know, we recently owned China with FXI. It was stronger in relative performance over EEM. But if we'd see a breakout here above the 800-pound resistance line, I want to own some of EEM if that takes place. So I'm going to try to see if it can prove itself. And, you know, the old adage that Sir John Templeton said, the four most dangerous words in all of investing history is it's different this time. We'll see if it's different this time, but if it does break out, this would be an encouraging place to be an owner. This is EFA, which we've owned for several months, and it's treated us well. EFA is up against a similar 800-pound resistance line at 1 in the upper right of the chart. Still own some of the original shares, and it's treated us well. Again, what EEM and EFA do against these old highs could really have a lot of influence. I mean, if October, my gut would say if October is going to end up making its historical 500 basis point gain, I would guess that both EFA and EEM are going to need to break out to make that happen. So we'll just have to see, but two really important resistance points. And almost a similar situation for the DAX. This is the DAX of Germany. On both charts the same, just a much closer view. The DAX, the red line is the 2015 high. You can see it remains in a solid uptrend. At 1 earlier this year, it looked really positive. That broke above the 2015 high, sucked some buyers in, then some selling took place. The next thing you know, it's back below the 2015 high. This is the 2015 high in the red line. And now we pushed higher, really strong over the last 4 weeks to 5. And now it's testing 2017 highs. So if the DAX can break out here, that would probably be good for EFA holdings, and would send a positive bullish message, I would think, to a lot of indices in the States. So a big test is taking place. If Germany would close where it is right now, as of Monday's close on a weekly basis, it would be a new high for the year. So big test is taking place at 2. So this is France. It has a similar looking chart as far as the red line. This is France, the CAC 40 in both charts, both weekly charts. Just the one on the right's a little closer look. But this red line is based upon the 2015 highs. Similar to Germany, you see it pulled above, sucked some people in, sold off, and now it's making another push to try to go back above. The highest weekly close looks to be about 54.27 for the CAC 40. So if the CAC can break above that level at 1, it'd be a positive for stocks in that index, and it also would send a positive message, I think, back here in the States. So just real quickly then, moving on to the reflation theme. I'm not going to spend a lot of time on this today, but I did want to do an update. This is the Thomson Reuters equal weighted commodity index on a monthly basis going back into the 1970s. So what, in the summer of 14, 3 years ago, we shared this looked like to be a right shoulder of a giant topping pattern. In hindsight, as I look back at that time, I couldn't find what I felt was a topping pattern that large. Since the summer of 14, commodities fell hard. We saw a counter trend rally starting in 2016. The bottom line is this long term, since 2011, remains in a downtrend. The counter trend rally hit the 23% resistance level, may have double topped, hit dual resistance, and backed off. Now this zoomed in box, again, this is a monthly chart. I just wanted to show you that as we historically, dollar weakness is historically bullish for commodities. We're going to get into the dollar later, but we've seen a potential short-term reversal in the dollar at long-term support. And you can see that this is last month's action, that just below dual resistance, commodities had one of the larger monthly bearish reversal wicks right here that you can find in a few years. So again, commodities have done okay in the long picture. They haven't proven that they can get out of the way of themselves, Again, this is a bearish reversal wick that could end up being tough on commodities. And we'll just have to see how important that 1 month. You can see there was 2 different bullish reversal wicks that not a lot of follow through, came through, but we can't overlook that there's actually 3 of them back to back to back, and then we see this potential bearish reversal. So the commodity bulls would just love to see this 5-year falling trend breakout, and if it would be a positive sign. But like I said, I'm not going to spend gobs of time on this indice, but I wanted to show you from a monthly basis, that's not a very pretty pattern for the bulls. So speaking of the dollar, this is the dollar on a weekly basis. The 92 level we've shared. I'm not going to today go back 20 years on the dollar, but many high and low inflection points took place around that 92 level. And so you can see, if we would go back on a long-term basis, the dollar became the most oversold since 2008, which was a pretty significant low in the dollar. So as it's hitting this support, you can see last week it pushed above falling resistance. It did back off its highs during the week, and obviously today's just one day, so it's hard to say that this weekly pattern means anything just at the close of a Monday. But we do see a push higher, and we're seeing momentum start to curl up. So historically, this can be a little rough. We know that oil has done well of late, and that could have to do with some dollar weakness. So we'll see what happens to oil if we get some dollar strength. A couple of charts on interest rates. It's easy to hear talk that interest rates are going up. Interest rates since the middle of 16, hey everybody, they are up a lot. Interest rates since 1993, they're down a lot. So the bottom line is the 10-year yield, this broader channel, continues to create a series of lower highs. It hit dual resistance earlier this year. Yields backed off and bonds rallied. We've highlighted this many different times that there was a large unfilled gap that came down here and became filled. It ran below that gap, and then it shot back up. The bottom line, really for the last few months, is yields are just trapped in this fairly narrow range in a longer-term downtrend. So the resistance is not too far overhead in yields, and obviously in the bigger case, if yields would someday they will. If they break above this falling channel 1, and especially above the 250 level, 260, 70, that would be really positive for yields and negative for bonds. But so far that has not happened. This is a look at TLT. We did own TLT, but what we had noticed is there was what I felt from a power of the pattern perspective was some potentially heavy resistance. Here's some choppy action in TLT. We bought TLT and then put a stop in just below in case a reversal would happen to take place. It did, and it stopped us out of this position. So at this time, we aren't long TLT at all. Got some small profits out of the position. For the most part, it's stuck in the range between 128 and 122. So that's 4.5–5% trading range, fairly narrow. Would look to be a buyer if TLT would happen to break back out of the 129 level at 1. Just as a reminder that from a TLT seasonality, that essentially from August to the end of the year, TLT usually does well. Here's the seasonality with 1 month that typically they don't do very well, and that's the month of October. And I kind of wonder if that's partially a reason, if we do see an inverse correlation between stocks and bonds, if stocks are historically strong, maybe that's part of the reason for bonds being typically weak in the month of October. But historically, you can see that TLT picks up about 150 basis points to 2 in the month of November, to another 100 basis points to 1.25 in the month of December. So it would be kind of ideal seasonality wise. And then January, you can see coming around next year, after October, the 90 days from November, December, January are typically fairly decent. So it'd be nice if TLT was back on support to be a buyer into the seasonality strength. The decline, this is a TLT bull bear situation. You can see that the decline of TLT in the last few months up here has really driven sentiment down as TLT was nearing resistance. You can see almost 80% of the people are feeling good about TLT, and then they get hammered and get a little bit of correction going on, and they wake up and they shake their head, and all of a sudden, next thing you know, TLT's down and you're down to 20% bulls. So historically, don't have a lot of bulls after the decline in bonds, of late. Like to see that back off a little bit more, see TLT, a month from now at some lower levels of support. It could be an interesting purchase. This is a reminder just of the stock bond ratio. This is SPY divided by the zero coupon bond ETF ZROZ on a weekly basis. You can see for the most part this year, 2017, it's just been a really choppy range. So there's not a bullish or bearish trend going on. The ratio, as stocks weren't doing really hot 60 days ago, and bonds were doing okay when TLT was rallying, you can see the ratio was down here at the lower level of the trading range, testing support. And then we've seen a push over the last month. And so far right now, this is just one, this weekly pattern is just one day, but the ratio is attempting to break out to the upside. So being long quite a few positions in stocks and indices and different ETFs of the like, this is a positive price action, and you'd like to see this ratio continuing to head higher if you're long any stock positions. From a valuation perspective, we won't spend a lot of time, but John M. from the States had asked about if, I looked at valuations and the macro point of view, and I put this in every month, the different valuation factors into the, or I share this in the Connect series webinars. This is a good perspective piece that I like from dshort.com. It looks back only 117 years, looks at 4 different valuation, measures. And so instead of trying to say one is really the best, they do a good job of looking at 4 different ones. And you can see historically, when you start looking back, this is the 1929 peak, the valuations are fairly, lofty. And so that, were valuations lofty in the late 90s? In 1995 they were lofty, in 1996 they were lofty, in 97 they were lofty, in 98 they were lofty, in 99 they were lofty. So, I think it's really smart to know when they are potentially excessive. I think just like the game musical chairs, you probably ought to keep your eye on the chair that's empty. If you're in a theater and somebody yells fire, it's probably smart to know where the exit sign is before you ever went into the theater. So just because these are lofty doesn't mean that you shouldn't participate to the long side. But I do think from the musical chairs and the fire exit, you really ought to know what you will do if markets reverse. But right now, I think people that have used this as the sole barometer to make decisions, they're probably a little frustrated, and they probably have some good-sized lost opportunity costs in their life. But I do show this because, Sir John had really some powerful influence on me on valuations, and I don't think this is anything to ignore, but someday the trend will change. I apologize, I'm not smart enough to know exactly when that's going to happen, but we're going to look at it mostly on a price basis. So, John, we do look at a lot of things from a big picture, but, all of us on this call have, 3 or 4 things in common. First couple come to mind are death and taxes. And, another one is real simple, is we all have something in common called we trade price. All of our judgments for our families and our bottom lines is based upon how we trade price, not how we trade valuations, and how we trade tax plans, how do we trade whether Trump will or won't succeed in the healthcare. We're trading price. And so that's what we're trying to help all of you most with, is how can we trade price successfully. Here's another look at The Buffett Indicator, which is corporate equities divided by GDP. I was just playing around with this. This is it's not quite as old as the prior chart, but it's still, a chart that goes back 6.5 decades. So it's a pretty decent time period. And this pink shading is just this is the only time in the last 65 years that where this indicator stands right now that it was higher. And essentially that was just 1999 and 2000, and that was it. So from a big picture perspective, another different valuation tool, it would appear that this market isn't cheap, but not being cheap doesn't mean the market has to stop its momentum, and so far we all know that it hasn't. Another look at sentiment from the CNN Fear Greed Proxy. This did catch my eye that the rally of late's got people fairly excited. This goes back, so it's 6 years, and you can see that right now there's about as much euphoria being expressed in their indicator as what we've seen at any time in the last 6 years. Now, obviously, being lofty didn't mean that the market went down right away, nor did it stop the upward trend, but it did get my attention that there's some pretty good feelings out there by a good number of investors. This is another piece from D-Short that I like that looks at this red slanted line is what they just want to call the regression to the trend, going back a little bit longer into the 1800s. And so what catches my eye is this is the zero line, in other words, the regression trend, and how far is the market above or below. And I was blessed as far as didn't know it to the degree that I do now, but when I got into this business in the early 80s, it was interesting that the dividend yield and the PE ratio were numbers that we haven't seen since. Some stocks, the dividend yield was even higher than the PE ratio, but this is what gets me here is the regression to the trend. It was 57% below, and that was where the Dow was below 1,000, and Sir John in 1982 said, I don't think we'll ever see these numbers again, and being below 1,000, he said, I don't think we'll ever see it again. And from a big picture perspective, he is really right. So this indicator would reflect that we're 103% above the regression, not quite as high as in 2000, but the bottom line is it's still a good bit above the long-term regression line of the S&P composite. So switching to just the metals kind of quickly, wanted to update the gold and dollar ratio. If you're a gold bull, you want to see this ratio heading up. In other words, that gold is stronger than the dollar. The ratio peaked in 2011. Regardless of the peak for the last few years, we just got a trading range going on, folks, from low to high and back high to low and back and forth. So the rally off of the lows earlier this year, as the dollar started turning weak, the gold strengthened, and this is a weekly chart. So 1, 2, 3, 4, 5, 6. About 6 weeks ago, quad resistance was hit in the ratio, and then you can see it's turned rather weak since, reflecting that gold has been much weaker than the dollar. So to really if a person wants to back the truck up in the metals complex, you really want to see this puppy breaking out of all of this resistance, and especially its sideways trading range, which is not happening. So this is not big picture bearish for the metals, but from a short-term perspective, this is not what the metals bulls want to see. This is a quick look at copper. This is kind of another example of XLF and buying Citicorp earlier. We liked the banks, but instead of buying the broad-based, we wanted to buy an individual stock that even had a better pattern. We did the same thing with copper. We liked the copper chart a few months ago, going back into May, but we liked the chart of Freeport-McMoRan even better. So you see copper held on support and it really rocketed higher. We were fortunate to have bought Freeport, which its gains were much larger than copper itself. But copper did run into this resistance at 1. There's a bearish reversal, and then you've seen it soften up, and then so it's softened up pretty good declines for 2 weeks, and now for the last 3, it's essentially just had this choppy schizophrenic action, not much net progress, creating you know, you could make an argument that's a doji star reversal, and then whoops, we have another doji star reversal, and then so far this week, which is one day, we just see a bearish wick. So there's a ton of indecision going on around this 295 level, you know, which happens to be, you know, very similar to 2014 lows and the 2015 highs. We just kind of think across here visually on a horizontal basis. So a support test is going on. I think it'd be really intriguing if we could happen to get a chance to buy copper back here at the 277 level. So no position in copper or Freeport at this time, but as we started off the beginning of this, we do own basic materials, so we'd like to see a little bit strength taking place, you know, because in copper, because that could probably help that position. Jason from Australia, he'd asked us to do a chart on the Aussie dollar. We look at this regularly, and if people are interested, we're always glad to share it more. This is a great proxy for commodities. So you can see that since 2011, the Aussie dollar has been weak. Since 2016, it's tried to be pushing higher. But you notice just a few weeks ago, it kissed, or the rally had it kissing the underside of this pink falling channel at 1, plus 2 other resistance lines, and momentum was quite lofty. So this was another reason to pull back on some Freeport and pull back on a few commodity exposures. But in keeping track, if you can see the Aussie break above this cluster of resistance at 1, it would be very good for owning the Aussie. It would be good for owning FXA, and it would usually send a positive a message for commodities, you know, overall. So commodities want to see continued strength in the Aussie here and not see it selling off. Real quickly on the oil complex, this is almost a 10-year snapshot look at crude oil. But one of the things, we've been sharing this for a long time, is this line A, for whatever reason, has been an inflection point of some key high and lows. And so you can see that here was a double bottom, 2 bullish wicks at 1, and then we saw crude rally from what, 80 to 110. That's a nice 30% rally taking place plus at that time frame. And then once crude started rolling over, you can see it declined and then came back to that line and just kept knocking on the door, month after month after month. You know, this is a weekly chart, but it just for a long time was here. Even tried to break out at the early part of it, but look at all these bearish reversal wicks, and then when it failed, sellers came in and went from 60 bucks down to 30. You see the bullish wicks down here. Earlier this year, it ran into that line again at 2. And so this is, in my opinion, is still an 800-pound resistance line. We've had this short-term rally of late. Again, this is a weekly chart just over the last few weeks. And then we see a small, and again, this is a weekly chart based upon last week, not today's action is not included in this chart, but it closed out the week with a reversal pattern up against this resistance line, and the close is that little notch right up here against resistance. So far it's banging up against a heavy resistance line that has been pretty tough to crack, you know, back in 15 and earlier this year in 17. So a narrowing pennant pattern has been going on. Not a lot of net progress either way, but this is a big test just below the 53, you know, level in crude. So crude bulls do not want to see any reversal or selling pattern take place, especially with this with the position that crude traders hold at this time. Back when crude started its meltdown from $100 down to 30, a very crowded trade took place. Obviously, it was one of the more crowded extreme trades going back into 2014, excuse me. We saw crude fall hard, and then traders really reversed from this extreme crowded position, which is historically bearish, to the lows in 2016 when it was in the $30 range. So the thing I want to just kind of make everybody aware of is that historically, crude is closer to a high than a low when traders own the positions that they do at this time. Again, it's a fairly crowded trade that's in play. And so on the prior chart, we showed crude up against that long-term resistance line. Crude bulls would not want to see selling take place against that line with this heavy of a crowded trade taking place in the crude market. This is a look at energy ETF XLE. Obviously, it's been not obviously, excuse me, but it has been one of the weakest of the main sectors in the S&P 500. Energy has really lagged. We saw a sharp counter trend rally that 1, 2, 3, 4, 5 took about 6 weeks to go from the bottom of the channel to the top. This is last week. You saw it still was up, but there was a small bearish reversal wick at the top of this falling channel. Excuse me. So very important for energy stocks, and crude that we just discussed on the prior charts. Energy bulls would not want to see selling take place up against this resistance line. On the flip side, we'd sure love if a breakout would take place. This sector has lagged for so many years could be a real positive. So this is a real make or break situation for the energy complex. So just kind of wanted to turn now to, as we get to wrap up in just the last few slides, excuse me, I wanted to remind everybody that, you got Halloween coming up and, the talk of harvesting and a harvest moon and all of that. But the point I want to make here is that, this is a time of harvest here in the Midwest, and we're going to see the good farmers, going after and harvesting their crops very soon. But if you'll notice that corn in the upper left and beans in the lower right historically have bottomed around the 1st of October. And you can see that corn usually does well in October, a little soft in November, but then has a good month in December, average gain of about 4%, and then followed by a nice 90-day start to next year. You can see that beans typically have a good seasonal pattern as well, starting in October. So these are way out of favor. They haven't done very well, but I just kind of want to remind you that the seasonality of these being a positive season are right in front of us. So in other words, about the time maybe the prices fall into harvest and then they start rallying, after that. So this is a look at grain ETF JJG. Obviously, it's struggled over the last few years. Traded as high in 2012. It's 2012 as high as $68, and now we're in the mid 20s. So I'm most intrigued by this support line. Grains are oversold and not very popular. You can see some choppy action just underneath resistance at 1. So excuse me, I don't own a position in JJG at this time, but I do have a buy alert set that if we get above the $26 level and break out, especially this time of year, I'm going to be interested in being a buyer. So another area that's not done very well from a commodity perspective is sugar. We can see it earlier this year was trading as just call it the mid 50s, and then got down into the mid 20s in just a 6-7 month time period. You can see momentum at the chart is greatly oversold. Could be making, to me it appears, a series of higher lows coming off of being oversold. We can see a potential series of higher lows. The thing that most catches my eye is there's just a fairly uniform falling channel that's taken place, this year, with sugar pressing up against the top of that falling channel resistance. So if we would see a breakout in sugar at 2, I'd be interested in being a buyer, especially when you look at the crowded trade that's going on. Right before the decline, you saw a very crowded trade that historically silver is closer to a high than a low when traders have accumulated this type of a position. You can see then that's where the sell-off in sugar has taken place. And now we have one of the most crowded positions in the sugar complex in a decade. So what would be a positive is to see some strength in sugar and see the reduction in this bearish crowded trade. Most of the people, traders at this time, are heavy weighted to being short And so if we would see this exposure be reduced, it could be a positive for SGG, which is the sugar ETF. I've got some buy alerts set on that if we see a breakout take place, I'll be the first to let you know. Another one, commodity that hasn't done very well either, is coffee. And so coffee, thing that sticks out to me is there was this large reversal wick that took place at potential support right here at 1. And we saw a rally. We traded that rally and then we sold into it. I'm glad that we walked away. For the most part, then coffee has been weak, and now it's testing the lower part of the body of this huge bullish wick that took place right here. So not too many coffee bulls at this time. A fairly crowded trades taking place in the coffee complex. We're watching this really close, and if we'd see a little bit of strength here, would be interested in being a buyer. One of our questions from Andrew today that came in is what were our thoughts about 3D systems. 3D, it's hard to believe. What in 2014 was trading as high as $90. In 2016 hit 7. For the most part, I put in the red line as resistance and the green line as support. DDD was up, I believe, about 500 basis points today. So high five to anybody that was long this. I'm not long at the time, but I do have a feeling of some positivity could take place if it could get above this dual resistance at 1. So just to let you know that this is on our radar screen, and if we see a breakout to the upside here, I'm interested in being a buyer, because there's a good bit of room that if it could run to the, it'd be a nice gain if it could happen to run to the top, do nothing more than run to the top of the trading range at 22, especially when it's trading at 14, because that top of that resistance is what, 50% above current levels. So I don't think the stock is too popular in the majority of people's thinking, because it's been hit so hard. But again, if we would see a breakout there, I'd be interested in being a buyer. So just as a reminder, as we finish up today, that we started off talking about how October is seasonally a good month, and you can see that its median return over the last decade is about 275, with an average return of 145 basis points. We've shared this list with you. I've created chart layouts on each of these charts with some different buy alerts on every one of these. And if we get these buy alerts, I'll let you know. We have made a purchase on United Rental. The thing that I don't know what it means, humbly everyone, but it did catch my eye that the 2 best seasonal stocks in the month of October over the last decade were both transportation stocks, and they were both airlines. Those are some pretty impressive numbers. So I do have the charts in play, and we have buy alerts that if both of them would start showing a little bit of strength and break out to the upside, I'm very open to buying those. And even if we would capture just half of the median return during the month of October, it'd be some pretty nice gains. So again, also we own Goldman Sachs. This is one of the bank holdings. You can see that its average, or its median gain, excuse me, in the month of October is about a little bit over 7%. Saw some positive price action in that. Bought it a few days ago. Again, in the banking sector, still have some exposure to XLF, still own some Citicorp, and then recently purchased Goldman Sachs. So I took some of the money, sold some of the shares of Citi, and rolled it over into the Goldman Sachs position because of its because of its pattern and its historical strength in the month of October. So I just want to again wrap this up and thank all of you for your memberships. Thank you for your questions. I like any feedback if some of those questions helped you at all. We invite those. I think they're very valuable. It actually makes it easier for me to come up with ideas, is answering your thoughts and your questions. So please feel free to send them, going forward. And again, I look forward to speaking with you on the first Tuesday of each month. I have to have some be on the road in the next day and a half or so, so I needed to get this done on a Monday. Sorry I didn't change at the last minute. But again, thank you all for your membership. It's humbling to try to work with all of you, and I wish you all the best. And again, our prayers go out to everyone impacted by what took place in Vegas. So all the best, everyone, and take care.